Right, welcome back to your beginner's guide to options. This is lesson number 5 in the series. So far, we've taken you through calls, puts, moneyness, intrinsic and extrinsic values. But today, we're going into lesson number 5, and that is, what are the reasons for buying and selling options? So, today's class, buying versus selling options. Now, in this section, we're going to explore the motivations and the strategies behind buying options, focus on speculation and protection, right? So like using it for insurance on a portfolio. We'll discuss how investors use calls and puts to capitalize on market movements and safeguard their stock positions. We'll also delve into the rationale for selling options, right? This is this murky water that as people just get used to and get to know options for the first time, a lot of people put a big risk warning on selling options, and sometimes for good reason. But once you get to know exactly why you would sell an option and in what scenario, which is what we're going to teach you today, then it becomes really interesting. So this includes how traders can enhance their positions, right? So it's yield optimization, additional yield, adding to your dividend. Enhancing your position by selling options to manage risk and also increase the likelihood of success in various market conditions. Now, when someone buys an option, they're usually doing so for a few potential reasons that we're going to go over here. The first is speculation. If I believe the price of a stock will rise in the near future, I may purchase a call option, right? Now, David Faber on CNBC said on Wednesday that he's hearing that Walgreens might still be a bid target. So the first thing I did quickly, the stock was up, 5-6% at that point, but the potential purchase price is probably 40% higher. So the first thing I did was quickly go on to Tasty, onto the options pricing for Walgreens and try and find a cheap opportunity just to speculate. I wanted to spend $200 to try and make $1,500, right? Pure speculation. So if I believe the price of a stock will go up or fall in the near future, then you buy a put or call to try and profit from this. So when you're buying a call, of course, there's unlimited profit because a stock has no limit to what it can go to. So with a call, you got unlimited profit, the risk premium if the stock doesn't rise. So you lose the risk premium if the stock doesn't rise, i.e. your lottery ticket, what you pay for it. On the put option, right, this is like car insurance. Unlimited profit down to zero. Of course, you've got that limit at zero. So you're buying puts and the unlimited profit down to zero. If you lose, again, it's just the risk premium if the stock doesn't fall below your strike level. Now, for protection, this is like your car insurance. Being long or short stock exposes me to large monetary risk. So I've got a pension portfolio, right, or an ISA, and majority of the time, everybody is long stock in their in their pensions. Therefore, do you sometimes want to protect the value of that pension, right? So that's one reason to buy put options. If I own 100 shares of stock, I can purchase a put option that allows me to sell those 100 shares at a strike price. For example, down 2% or down 5% from where it is. So, we often see stocks drop 50%. You are able to get out for 2% or 5% if you've got a put option. This completely protects my investment from the put strike down to zero, excluding the cost to purchase the put. What about hedging, right? What about selling options? And this might be the first time you've ever thought about selling options. When somebody sells an option, they're usually doing so for the following reasons. One, hedging. If I own 100 shares of stock, I am able to sell a call option, right, up here against the shares that I own. So as they tick higher, I pre-agree to sell them at this level. right? So I'm selling the call option against the shares, and that's hedging the cost of me buying the stock, right? I own Nike shares currently at $76, but I know I want to sell them at 85. So I simply sell an 85 call and receive 2% for that. So some people will think that means that the cost of buying Nike stock is 2% less. I'm exchanging the unlimited unknown upside profit from owning the stock, right? I'm exchanging that for a potential for guaranteed cash right now, the 2% premium that I'm paid for selling a call option. If I'm short 100 shares of stock, okay, so I benefit as the stock goes lower, I just sell a put. And if I sell a put down here, so if I'm short British Aerospace stock, okay, I think £12 is probably where I'd be happy to cover that short. So as the stock drops, okay, I've got unlimited profit from the stock dropping. If suddenly, you know, like back in 2008, there was an investigation into British Aerospace corruption, right? Then the stock might drop 20%. I mean, it dropped 10% in 2008, but I exchange the opportunity for that unlimited downside down to zero. I short puts, so I'm selling a put, and then the opposite the covered call, that allows me to reduce the cost of shorting the shares. So if I receive 2% for that, that means I've made an additional 2% on shorting the stock, or I've shorted it 2% higher, however you want to think about it. But I'm capping the unlimited downside profit potential. Now, what about trading the probabilities? The beauty of options trading is in creating strategies around a stock price, right? So I can do a whole strategy. I can put whatever my feeling is on the stock, I can create a strategy using options. Instead of needing directional movement to profit, options can even generate returns within a price range, increasing success probability above 50%. For example, if XYZ, Nike, is $100, selling an 80 strike put allows profit if the stock stays above 80. Right? At the moment, as you know, I really think Vodafone will stay above 62 pence. So I'm short a lot of the 62 puts in Vodafone. And I receive 4 pence for doing that. So that means that I've taken an income of about, what's that, 6% for saying, right, as Vodafone goes down, I am prepared to sell puts. As long as it doesn't go down, then I take that premium. Trading the probabilities continued. If XYZ stock is trading at $100, I can sell a call option contract at the 120. So this, again, in Vodafone, if I sold the puts at 62, but I know the German business hasn't turned around that much yet, I know it's not going above 80 just yet, so I can sell the calls at 80. Then I am creating this sort of collar between 62 and 80. If the stock trades between those two, then I win on both sides. I can even combine these two concepts to collect more premium, creating a trading range between 80 and 120. In Vodafone's sake, 62 and 80. The trade-off is that I take risk on both sides of the market, right? For the opportunity to collect more premium and have a wide range of the stock price to move. So you do this if you're confident a stock is going to trade in a range. So what are the takeaways? Buying and selling options. Investors can fully protect a long stock position by buying a put option at the strike price. Traders can fully protect a short stock position by buying a call option at the strike price. Okay, so if I'm short a stock that may get bid for, right, it's either a really bad stock or it's going to get bought, then I can protect that short stock position by buying a call option at the strike price. Investors can reduce costs and increase success probability by selling a call against the long position. That just limits the upside potential. Traders can reduce costs and increase the success probability by selling a put against the short position, but limits the downside to zero, right? But limits that downside. Investors can use short option strategies to profit within a price range by betting against price movement. And that's when you start to think about volatility, right? How volatile do we think a stock is? Is it going to be less volatile than the market is pricing or more? So that's, some of those takeaways from buying versus selling options.